What I don't understand here is we've got coordination in Portugal and Citra, the meeting a few days ago, and within 10 days that's exploded into what I would call the Yellen divergence. Is that the way you see it?
Oh, definitely a divergence. I think it's interesting that for both the Bank of England and the Fed, inflation is not coming in as much as they had expected. And so relative economic growth, relative dollar a weakness, given the fact that the Fed is not likely to raise rates as aggressively as what we saw in the dot plot.
See, I don't know, John. We've been talking about a divergence for as far as I can remember. It's been 3 years of divergence, and it hasn't happened. Why is it different this time?
Well, a divergence initially was that the Fed was going to act first. And the Fed did, in fact, act first and start raising rates. Now the thought then became, well, now the ECB and others are going to catch up to the Fed. And all of a sudden now we see that the ECB, and especially we'll wait for Draghi at Jackson Hole and his comments, but we're going to see now the Fed is probably going to back off a little bit. Notice Chair Yellen was a little bit more hesitant on how committed she is in terms of her inflation forecast going forward. So now the divergence has sort of gone backwards. Now it's like, well, maybe we won't get as much in the U.S. in terms of Fed tightening, and maybe we'll get more in terms of maybe Bank of Canada moving forward or the ECB. So it's interesting touch and go in terms of who's running this race in terms of raising interest rates.